IPSAS 26 is an important accounting standard. Its main purpose is to ensure assets are reported fairly. This standard guides public sector entities. It helps them account for assets that have lost value. This is crucial for accurate financial statements. IPSAS 26 ensures that assets are not overstated on the balance sheet. Overstated assets can mislead users of financial statements. Proper application of IPSAS 26 leads to more reliable information. This reliability is key for public trust. It helps stakeholders make informed decisions. Taxpayers and lenders rely on this accuracy. IPSAS 26 applies specifically to cash-generating assets. These are assets held with the primary objective of generating a commercial return. The standard does not cover all types of assets. For example, non-cash generating assets are treated under IPSAS 21. Applying IPSAS 26 offers significant benefits to public sector entities. It enhances transparency in financial reporting. This allows stakeholders to see the true value of public assets. It promotes sound financial management practices. Cash-generating assets, or CGAs, are a specific category. Under IPSAS 26, their primary objective is to generate a commercial return. This means they are used to make money. The cash inflows from these assets are largely independent. Identifying them requires careful consideration of their purpose. This distinction is vital for applying the standard correctly. Examples can include public utility companies providing electricity or water. Toll roads operated by a public entity are another example. Publicly owned transport services that charge fares can also be CGAs. It is important to distinguish CGAs from non-cash generating assets. Non-cash generating assets are held for service potential. Their primary purpose is not to make a commercial return. They deliver public services or support government operations. Administrative buildings used by government departments are typically non-CGAs. Public parks offering free access are another common example. The public sector presents unique challenges in identifying CGAs. Management must exercise careful judgment. Impairment occurs when an asset's recorded value is too high. Specifically, its carrying amount exceeds its recoverable amount. An impairment signifies a significant and unexpected decline in an asset's service potential or economic benefits. Impairment of cash-generating assets can happen for many reasons. Economic factors play a large role. Physical damage to an asset can also cause impairment. Technological obsolescence can make an asset less efficient or uncompetitive. Changes in how an entity plans to use an asset can also lead to impairment. These factors reduce expected future cash flows. Depreciation is routine. Impairment is exceptional. Recognizing impairment in a timely manner is very important. It ensures that financial statements reflect the economic reality of an entity's assets. Failure to recognize impairment leads to an overstatement of assets. Accurate impairment accounting supports a true and fair view of the entity's financial position. Section 4. Spotting the signs indicators of asset impairment. Public sector entities must regularly assess their assets for impairment. At each financial reporting date, entities must check for indicators. These indicators suggest an asset might be impaired. This proactive approach is required by IPSAS 26. It ensures that potential impairments are identified promptly. Management plays a key role in this ongoing monitoring process. External indicators of impairment originate from outside the entity. Significant declines in an asset's market value are a clear sign. Adverse changes in the economic, technological, or legal environment can also indicate impairment. An increase in market interest rates could affect an asset's recoverable amount. Internal indicators of impairment arise from within the entity. Evidence of physical damage to an asset is a common internal indicator. An asset becoming idle or plans to discontinue its operation suggest issues. Major restructuring plans can also trigger impairment considerations. Worse than expected economic performance from an asset is another key internal sign. The presence of an indicator does not automatically mean the asset is impaired. Further investigation is needed to confirm and measure any impairment loss. Section 5. The impairment test. Calculating recoverable amount. The impairment test is a formal process conducted when indicators of impairment are present. It involves comparing the asset's carrying amount with its recoverable amount. The recoverable amount is the higher of fair value, less costs of disposal and value in use. If the carrying amount exceeds the recoverable amount, an impairment loss exists and must be recognized. Section 6. Accounting for impairment, recognition and reversal. When an impairment loss is confirmed, it must be recognized. The amount of the loss is the difference. It is the carrying amount of the asset less its recoverable amount. This impairment loss is recognized immediately in the financial statements. For most cash-generating assets, the loss is reported as an expense. It appears in the statement of financial performance, often called surplus or deficit. Recognizing an impairment loss has a direct impact on the financial statements. The carrying amount of the impaired asset is reduced. It is written down to its recoverable amount. This new, lower carrying amount will be the basis for future accounting. For example, future depreciation charges will be calculated on this new value. IPSAS 26 also allows for the reversal of an impairment loss. Entities must assess at each reporting date. If a previously recognized loss may no longer exist, there are limits on how much an impairment loss can be reversed. The reversal of an impairment loss is also recognized in surplus or deficit. Section 7, IPSAS 26 in action, benefits and practical considerations. Let's consider a real-world example. A public entity operates a toll bridge that is a cash-generating asset. A new free public highway opens nearby. This causes a significant drop in traffic and toll revenue for the bridge. This decline in revenue is an external indicator of impairment. The entity must then perform an impairment test. If the bridge's recoverable amount is less than its carrying amount, an impairment loss is recognized. Applying IPSAS 26 can present challenges for public sector entities. Identifying whether an asset is truly cash-generating can be complex. This is especially true for assets with mixed public service and commercial objectives. Estimating future cash flows for the value in use calculation is often subjective. It requires robust assumptions and reliable data. Determining fair value, less costs of disposal, can also be difficult if active markets do not exist. Despite challenges, proper application of IPSAS 26 is vital for public trust. Accurate financial reporting builds confidence among citizens, investors, and other stakeholders. It demonstrates responsible stewardship of public funds and assets. This benefits society as a whole.